We've all heard the dream, making money while you sleep, and for many new investors, dividend stocks seem like the golden ticket. You buy a piece of a company, and it pays you just for owning it. It's the ultimate passive income machine. So, you open your brokerage account, run a stock screener, and, whoa, you see these numbers. While most of the market is paying 1% or 2%, these companies are offering 10%. You do the math. If I invest $10,000, I can get $1,000 a year. It feels like a shortcut to wealth. But here is the single most important lesson for a new income investor. In the financial markets, there is no free lunch. An abnormally high dividend yield is almost never a bargain. More often than not, it's a distress signal. It's called a dividend trap. And today, I'm going to show you exactly how to spot one, how to analyze a dividend like a professional, and how to avoid the phantom yields that can destroy your hard-earned principal. First, we need to understand what a dividend yield is. It's a simple formula, the company's annual dividend per share divided by its current stock price. Now there are only two ways for this yield percentage to get sky high. 1. The company massively increases its dividend. Or 2. So, the stock price has massively fallen. Guess which one is more common? When a stock's price falls off a cliff, its trailing yield, which is based on the dividends it paid over the past 12 months, looks amazing. But the market is pricing in a harsh reality. It's screaming that the company is in trouble, and that the dividend is probably about to be cut. Let's look at a textbook dividend trap from 2025, ZIM Integrated Shipping. In November 2025, a new investor would have seen ZIM on their screener with a staggering 47.99% yield. But a professional investor doesn't ask what, they ask why. ZIM is in the hypercyclical shipping industry. After a massive once-in-a-lifetime boom, shipping rates returned to normal. And here's the smoking gun. The company was projected to swing from a big profit to a significant loss. And as a result, analyst forecasts for the 2026 dividend showed a cut of over 99%. The company was projected to swing from a big profit to a significant loss. And as a result, analyst forecasts for the 2026 dividend showed a cut of over 99%. Any investor who bought ZIM for that 48% yield was walking directly into a trap. Their income would evaporate, and they'd be left holding a stock that was losing money. So, where do you find these 10% yields? Not from blue-chip companies. You find them in complex high-risk asset classes. Let's look at the two most common. First, business development companies, or BDCs. These companies are like publicly traded banks for small and medium-sized private companies that can't get a traditional loan. Their yield is high because of their tax structure. To avoid corporate taxes, they are legally required to pay out at least 90% of their taxable income to you, the shareholder. But here's the 2025-2026 risk. The private lending world has become hyper-competitive. This is squeezing their profits, 17, or forcing them to make riskier loans just to keep those high yields, high 19. Second, mortgage REITs, or mREITs. This is critical. mREITs do not own buildings, they own debt, specifically mortgage-backed securities. Their business is to borrow money at low short-term rates and buy higher-yielding long-term mortgages. Their profit is the spread in between. The risk, they are in a catch-22 with interest rates. If rates rise, their short-term borrowing costs spike, crushing their profit. But if rates fall, which is what everyone wants, homeowners refinance. This is called prepayment risk. The mREIT gets its money back early and has to reinvest it at the new lower rates, crushing their profit all over again. That 12% yield is what the market demands as compensation for this extreme volatility. Okay, so how do you tell a safe dividend from a trap? This is the most important part of the video. You have to look at the payout ratio. But here is the biggest mistake a new investor can make. You cannot use the standard earnings per share, or EPS, to analyze BDCs and REITs. It's a completely misleading number for these sectors because of non-cash expenses like depreciation. You must use the industry-specific metrics. For BDCs, you use net investment income, or NII. This is their real profit. The test is simple. Net investment income per share must be greater than or equal to the dividend per share. Let's use 2025 data. Look at Ares Capital, ARCC, a blue-chip BDC. In Q3 2025, its net investment income was $0.48. Its dividend was $0.48. That is 100% coverage. It's sustainable, but with zero margin for error. Now look at Main Street Capital, Maine. In Q3 2025, its distributable NII was estimated at 1.01 per share. Its regular dividend was 0.765. That's over 130% coverage. That is a safe dividend. For mREITs, you use EAD, earnings available for distribution, or AFO. This is their real cash flow. The test is the same. EAD per share must be greater than or equal to the dividend per share. Let's look at AGNC Investment Corp, a popular mREIT. In its Q3 2025 earnings report, its distributable earnings, EAD, were 0.35 per share, but during that same quarter, it paid a dividend of 0.36 per share. It failed the test. It paid out more than it earned. That 14% yield is a trap, and a dividend cut is extremely likely. There's one more trap, and it's the most deceptive. It's the covered call ETF. You'll see funds with names that promise high income, and they deliver 12% or more. They do this by holding stocks and selling call options on them, collecting a cash premium. But here's the secret. The monthly check you get is a distribution, not a dividend. By law, that payment can come from three sources: real income, capital gains, or return of capital. Let's look at a real example. The Global X S&P 500 Covered Call ETF, XYLD. Its yield, 12.13%. But its October 2025 Section 19A notice estimated that its distribution was 96.86% return of capital. You read that right. Of that 12% yield, only a tiny fraction was real profit. The rest was just your own money being handed back to you. This is a phantom yield. Your skerredokunsi insanan. Liquidating your own principal and paying a management fee for the privilege. Finally, you have to understand that not all income is taxed the same. This is for taxable brokerage accounts, not retirement accounts like 401ks or IRAs. Dividends from most regular companies are qualified dividends. They're taxed at the low long-term capital gains rates, 0%, 15%, or 20%, depending on your 2025 income. But the distributions from BDCs and mREITs are typically ordinary dividends. They are taxed at your high ordinary income rate, the same as your salary, which can be as high as 37%. Here's the trap. You buy an ETF for $100. You receive $10 in distributions, which is all return of capital. Your new tax basis is now $90. A year later, the price has eroded, and you sell it for $95. You think you lost $5, but the IRS says you have a $5 taxable capital gain because you sold it for $95, and your adjusted basis was only $90. You lost money on the share price, but you still owe taxes. It's the ultimate trap. Look, the allure of a high-yield shortcut is powerful, but building real sustainable wealth isn't about harvesting your principal. It's about focusing on total return. That's the dividend plus the growth of your original investment. The most reliable path to high income isn't finding the highest yield today. It's finding high-quality companies with a long history of growing their dividend year after year. That 3% yield from a rock-solid company might not look exciting now, but when it grows by 10% a year, it becomes a 4%, 5%, and eventually a 10% yield on your original investment. That's how you build lasting wealth. So be a dividend detective, not a yield chaser. Check the fundamentals, use the right metrics, and never, ever invest in a yield you don't understand.